RMDs do not save you tax. In this episode, I'm going to address the question, why does taking RMDs cost more in tax? A lot of times, financial advisors, tax advisors do not calculate this. They are myopic. Learn why. So my name's Doug Andrew, and I've helped people prepare for a comfortable retirement by optimizing their financial assets and minimizing taxes. And I've been doing this now for more than 47 years. I really think that a lot of Americans get duped into putting their savings into traditional IRAs and 401ks, thinking they are going to be in a lower tax bracket when they retire. But that has not been true, nor axiomatic now for more than 30 years. People are not in lower tax brackets if they save very much of a respectable retirement nest egg. Very few people find themselves in a lower bracket. Now, these two things are certain. Money will never be worth more than it is today because inflation constantly erodes away the purchasing power of those dollars, and your current tax bracket is likely the lowest bracket you will ever be in. Now, let's just shoot straight here. When I go around America and I speak to audiences and I ask them, okay, how many of you think in the long run future taxes will be lower? I get nothing but crickets. How many think they're going to be the same? One or two hands go up. I say, how many of you are convinced taxes in the long run will likely be higher? And a sea of hands goes up. And it's because of irresponsible government spending, the printing of money, and on and on and on. They can see the writing on the wall. As of the recording of this episode, the IRS collects between $3.5–4 trillion a year in taxes. And this is the Biden administration. And what we're talking about here is tax increases and spending that is triple to quadruple that. If you were making $100,000 a year and you constantly kept spending $300,000 or $400,000 a year, what would eventually happen? Yeah, you'd have to file bankruptcy. Unless something changes, we are in trouble in this country. The fact of the matter is, taxes will likely be higher in the future. So why do we continue to accumulate and defer tax to some future perceived unknown advantage until it grows to this big nest egg, and then withdraw that money down the road when we're convinced taxes will be higher? That doesn't make sense. So people sometimes go, oh, then you're promoting a Roth. Well, let me shoot straight with you here. I've never owned an IRA or 401k, never will, but 91% of Americans are duped into putting pre-tax dollars into IRAs or 401ks for the tax benefit of the present without really calculating how much they're going to pay down the road. It's sort of like a farmer who can either buy seed in the springtime and they get a tax break when they pay for their seed and they plant it, they cultivate, they irrigate and everything. And then later on in the fall when they harvest their crops, now they have to pay tax on what they sell their harvest for. That's a traditional IRA or 401k. What if you could just pay tax on the price of the seed in the springtime, and later on in the fall, you could sell your harvest without paying tax? That's a Roth approach. It's a step in the right direction, but I've never owned a Roth IRA or 401k and never will. You'll understand why as you stay with me here. By the way, if this is intriguing you, you ought to share this episode with somebody. Click on like and subscribe. I post an in-depth answer to a financial question almost on a daily basis. I don't want you to miss out. I have over 500 educational videos on this very channel. But stay with me to the end, because I want to gift you a free copy of my most recent 300-page best-selling book to empower you on doing something better than being duped into putting money into these tax-deferred vehicles and then taking RMDs, which is the question I'm addressing in this episode. So what do most tax advisors, financial planners tell you to do when you hit age 59 and a half and you can access the money without a 10% penalty? What do they tell you to do? Most financial advisors, whether you're retiring or not, even though you can access money in an IRA, a 401k, a 457 without a 10% penalty now. And by the way, at 457, you can do that if you leave your employer before age 59 and a half. They say, well, if you don't need the money, continue to defer and stretch it out until you're age 72. Now, that sort of sounds on the surface pretty reasonable, right? Why would you take out the money and then pay tax? Because you're going to pay more in tax this year. The reason why I call it myopic is because most CPAs, most tax people only are looking at a given year. It's short-sighted. They're saying, well, if you want to save tax this year, then keep your income down and don't take anything out of that 401k prematurely. Just keep deferring. Now, defer is also a synonym for procrastinate. You want to keep putting it off. When has procrastinating things turned out good for you? It hasn't for me. So if the accountant said, why don't you continue to procrastinate paying the tax until you're in a higher bracket later, and then you'll pay more down the road. Now, if they actually said it that way, you'd go, what? That doesn't sound reasonable, because they're only looking at a given tax year. This is what prompted me years ago to develop a software program. So years ago, I developed a software that basically showed the people that came to me the darkness of the night, so to speak, if they kept money in their 401ks and their IRAs past age 59 and a half and kept deferring until age 70 and a half. That's the age that you used to have to start taking out money. Now it's age 72. And then if they took out RMDs, required minimum distributions. And I would compare that, because if they deferred, usually from age 59 and a half to age 70, 72, their balances might double again tax deferred. And then they start taking out the required minimum if they don't need the money, thinking that's saving tax, maybe in a given year. But my software would show them the darkness of the night when you added up all the taxes you pay until you string it out to your life expectancy and your spouse's life expectancy. And they were flabbergasted with how much they would pay in tax by stringing it out. They continue to be in partnership with Uncle Sam. And they say, well, why do they tell you to do stretch IRAs and put it off on CNBC? And I would go, who's funding CNBC? Government revenuers. Why would they want to kill a partnership where they can continue to get a third or more of everything you will ever earn the rest of your life and your spouse's lifetime, and into your children inheriting that IRA or 401k, which most savvy CPAs and tax attorneys say the worst place to leave your money when you die is in an IRA or 401k for your kids to inherit. And people go, really? Yeah, you'll understand when you read my book that I want to gift you at the end of this episode, okay? So what happens? You reach age 72, and now the government has been counting on the tax revenue. They actually budget planning on how many people are going to turn age 72, because they must start taking money out of an IRA or 401k, a qualified plan, based upon your life expectancy. So let's say you had $1 million nest egg. You have a life expectancy, let's say, of 20 years. You have to take out 1/20th of the million, or 50,000. If you don't, there's a 50% penalty on top of the tax, because you have to pay tax. Why? Because the government wants that money out and taxed. They've been waiting for that tax revenue. If you do not take out the required minimum, there's a 50% penalty. So what do most people get duped into doing? Taking out just the minimum. If you don't need the money, why would you take out more than you have to? Because you're going to pay more in tax. Well, what if I were to reword it? Well, you can take out the minimum and continue to postpone and delay and procrastinate, and you'll actually pay more in tax by taking out the minimum. Would you like to just get the taxes over and done with in today's lower tax rates? Well, what should I do with it? I don't need it. You don't have to spend it. You reposition the after-tax money into something that's going to be tax-free from now on, and probably earn a higher rate of return. And at the end of the day, when you pass away, it blossoms and transfers tax-free. It increases in value and reimburses your spouse, your kids, for all the tax that you paid in most cases. People go, I've never heard of this before. Yeah, it's called a strategic rollout. So I said strategic rollout, not a rollover. A rollover is like going from the frying pan into the fire, so to speak. That's taking money out of a 401k and putting it into an IRA and continuing to delay the inevitable till you're age 72, and then taking RMDs. I can prove to you mathematically that usually will cost you far more in tax over the long haul. So I would help many, many people strategically roll the money out. Starting at age 59 and a half, by age 64 and a half, they would have their money out of there. If they had $500,000 in their IRAs or 401ks, we might pull out $100,000 a year for 5 years. I've had people with $1 million in their IRAs or 401ks, and we pull out $200,000 a year. We get the taxes over and done with sooner than later, and then take the net after-tax money and put it into a maximum funded indexed insurance contract that will allow them to accumulate the money tax-free at 7, 10% and greater rates of return, but it's totally tax-free. And every million can generate $80,000, $90,000, $100,000 a year of tax-free income for as long as they live. They do that using my favorite instrument called the laser fund. Now, what's that? The laser fund is the only vehicle that I'm aware of in the Internal Revenue Code that allows you to accumulate your money totally tax-free under Section 72E. You can access your money tax-free, and you don't have to wait till you're 59 and a half. It's not a qualified plan. You can access your money tax-free for as long as you live. And when you ultimately die, anything left in there blossoms and increases in value and transfers income tax-free. I'm 69. If I died tomorrow, every million would blossom to about $2.5 million and transfer tax-free. There's not an IRA or 401k that'll do that. Now, I want to gift you a copy of my most recent 300-page best-selling book that will explain this laser fund, but let me just tell you 2 quick little examples of what it does. I had a husband and wife, 2 school teachers years ago that came, and their advisor at age 59 and a half said, oh, continue to defer. They had $250,000 in their 403Bs, okay? Conservatively, that $250,000 would have doubled to $500,000 by age 70 and a half, which is the age they had to start taking RMDs back then. I calculated and showed them that if they strung that out, they would pay a minimum of $250,000 of unnecessary tax. They went, we never thought of it this way. We did a strategic rollout. We basically took out $60,000 a year for 5 years and got the taxes over and done with because it was still growing. And so they got $300,000 out, the taxes over with, and we repositioned that into a portfolio of laser funds. We saved them over $250,000 in taxes. Now they're enjoying double the income on that $500,000, and it's totally tax-free. And when they die, it blossoms and leaves behind about 4 times as much as their IRAs, 403Bs, and the various accounts we're going to do for their children, their posterity. I had another real estate guru. He had $600,000 accumulated based upon his tax advisor taking the 4% rule, about $24,000 a year out. He was going to pay taxes of $8,000 a year, netting $16,000. In 5 years, we saved him $750,000 of tax, $750,000 in tax. He now has quadrupled the income. He is experiencing between $60,000 a year and some years $75,000 a year of tax-free income versus the $24,000 before tax income out of his 401ks. You can do this. So I want to gift you a free copy. Here's how to claim your free copy. Go to laserfund.com, laserfund.com. Click on the link below. Contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I'll fire out a hard copy to you. This is 2 books in one. This white side is 200 pages with all the charts and graphs and explanations. If you learn by stories, you flip it over and read this 100 pages, and it has all kinds of client stories and examples of how you can do this instead of being duped into taking RMDs, okay? Worst advice I've ever heard, and it actually costs you more in money, and you'll learn why in this book. Now, there's also options there to listen and learn, watch and learn, but claim your free copy, and there's also some information there to be able to learn from webinars or on this very channel. I have 500 plus educational videos that will help empower you on how the laser fund works. And this is where I've earned average rates of return between 7 to 10% and even higher for not only myself, but for thousands of people that learned how to employ the laser fund.